Well, thank you, Angela, for the introduction and for being such a great leader at SIOR. And Commissioner Bisaquino, thank you for the opportunity and hope I don't get a lifetime ban for this program change. This session is being recorded, so before asking a question, please proceed to one of the standing microphones we have set up around the room. This is NAIOP Sports Talk Radio, Long Beach. I'm Jim Klein, your host for another segment of Coach Talk, and we'll be analyzing the first half of the season with an all-star lineup. Gene Riley, head coach of the Prologis Bombers, boasts the largest holdings of any team in the league at $58.5 billion in value and 654 million square feet under management. The Bombers just completed a major acquisition which a few of you may have read about. Coach Riley wins under extreme pressure and tackles very large-scale industrial development. Carl Panattoni, owner of the Panattoni Pirates, longest win streak in the game for over 30 years. Active nationally and internationally, he's one of the largest private developers. With 200 million square feet of projects under the Pirates' belt, perhaps it's those goal line upsets that really makes the character. If you search the wisdom of Carl Panattoni, you'll see exactly what I mean and be richly rewarded. Jim McShane, owner of the McShane Titans for 25 years, awesome switch hitter, developing several product types, including industrial, office, multifamily, and healthcare, gives the Titans multiple weapons at the plate. One competitor trying to figure out the McShane playbook told me they are stealthily going around the country, landing one big deal after another without any discernible pattern. Hope we get a clue today. Jeff Phelan, batting cleanup, former MVP of the Panattoni Pirates. After contract negotiations broke down, Jeff went on to found his own team as free agent and now serves as player coach for the DCT Tigers. National in scope, tearing it up on the acquisition trail, the Tigers have 73 million square feet of real estate with a value of $4.7 billion. So the agenda today is we're going to play 4 quarters and discuss where is the yield, are markets in balance, how public and private developers differ, and what can disrupt the cycle. But first, we're going to do a little warm-up with some national coverage as we go around the U.S., and I'm going to give the ball to Carl to discuss the Bay Area and what he sees generally in the market today.
Well, the Bay Area is the most idiosyncratic market in, I think, the United States. It is so dependent on the high-tech industry, not dependent upon it, but governed by it, that it's been booming now for 5 years, and I'm really booming. Land values have tripled, and building values have done the same thing. In our industry, in the industrial industry, what's occurred is that all of the industrial space, older infill space, we'd call it in most communities, have been changed to lofts and high-tech offices. So the actual industrial inventory has been decreasing, which means that if you can have an industrial project, you've really got something that's special. Now that's the good news. The bad news is that everybody knows it, and land values within the Bay Area community are now approaching $35 a square foot in even some of the East Bay communities. And so for an industrial developer, that's heart attack territory. And, but that's the way it is. It's a special spot, though, if you can find a way to play.
Carl, while we got you, you mentioned something about frothy markets. And I don't know exactly what you mean by frothy. So I don't know if you still have that opinion, but
Well,
I'd like to find out what
I
frothy
think everybody
means.
in this room has that opinion. If anybody's looked at cap rates recently, there is so much money chasing all product that it distorts your analysis of the project. Because now we are building a lot more spec than we were, of course, 2 or 3 years ago. But as one of my partners said, you know, I'd much rather have a tenant in search of a building than a building in search of a tenant. And we're starting to see that scenario in different places across the United States. Even though, if you look at the numbers, absorption is higher than the new speculative construction, these things do change and can change in a hurry. So the market is frothy right now, but the underlying fundamentals seem very strong. And quite frankly, the not mediocre, but only adequate performance of the economy in general is a good thing, I think, because I think that probably gives the process legs over the long run as opposed to burning out fast. But right now, the amount of money chasing deals is high, and if interest rates start going up, what happens to alternative investments, and do we start seeing a cutback in that? That's one of the big fears that all of us have. But at the moment, everything looks like it's hitting on all cylinders.
Jeff, can you say the same thing about Southern California?
Yeah, I think I would. I'd repeat everything Carl said, and I'd add on top of that that we're seeing good recovery also now with competing with tenants. We've got tenants and users that are out there that are trying to buy their product now. You've got very capable developers that are competing for same pieces of land, and the land prices are going up. But more importantly, the thing that I see now that wasn't the case 2 years ago is there just aren't any available land sites to even fight over. I mean, that's the other issue. So just finding the land, period, so you can fight over it is a very difficult thing for us as a company to do that and make the numbers work.
One other point while we have you, what about deals that you're seeing? Would you do those deals, or you see people doing deals that maybe they shouldn't be at this point in the cycle?
Well, when I think about that, I think about myself having talked people into doing what they thought was crazy at one time, and was able to steal home on it and do just fine. So it's hard to pick on anybody in today's environment when you're in a market that's moving upward. Cap rates are still compressing, rental rates are increasing. So even though there are a lot of people out there, you're passing on the deals, when you look at it and you look back, you know, everybody out there is doing well because we're in an upward market. I think the bigger question is, when do you have the discipline to stop and kind of let the market correct itself? And how do we do that, and when do we do that, I think is the bigger question.
Well, I'll be asking you that in
Later,
just
yeah.
a few minutes.
All right, sounds good.
Jim, if you wouldn't mind talking about the Midwest, Chicagoland, and compare that a bit to California, where you've had some pretty good success recently.
Well, first of all, I think the Midwest is way behind the West Coast, the East Coast, and probably Texas. We've got a critical mass in the Midwest, especially in Chicago, of 1,300,000,000 square feet of industrial. That helps. These companies are moving out of some functionally obsolete buildings. And if you guys know here in the West Coast what people are moving into, they're different buildings. Parking is an issue for a lot of these buildings. You know, where we used to build 5-6% office, geez, we're putting 25% office in some of these, you know, industrial buildings. So parking's been an issue, parking of trucks is an issue, and we have the very same issue with land. I think when we look at San Francisco and the Oakland market, we see, I don't think it's frothy, but a supply and demand that's out of whack. I mean, it's hard to see much vacancy in the industrial sector up in that part of the world. The thing that, Jeff, I would say to you is when I look at it is when people start to resist the rent numbers. Because land at $35, you guys know, I mean, we're talking about selling some of these industrial buildings for anywhere from $150 to $200 a square foot. There will be a point where the resistance is such that the high-tech companies, and you know who these high-tech companies are moving to places like Austin, Texas, maybe with their back room first, then maybe a little bit more of the back room, maybe some more of the higher tech people. You know, you can just operate in some of these other cities cheaper. So as the world gets more competitive, and I think in this Oakland market in particular, you'll see rents go up, and then there's going to be a resistance point. I'm not sure where it is, Jeff, but we're on our way there. And so when do you stop? Well, I don't know where we stop. We just have to kind of really watch the market because this market moves on a dime. You brokers out here know that. When somebody starts looking for space, they're looking for space and they're having a hard time making the numbers work, and they start to go to Phoenix or they start moving over to Nevada, that's when the resistance hits. And so that's what we pay a lot of attention to.
Well, Gene, if you would talk about Texas a little bit to see if you're hitting some perhaps resistance there, and also give us a little bit of that East Coast area.
Sure. With respect to Texas, that is probably the place where we're seeing supply get a little bit out of hand. I mean, I think we'll get into it later on, but you know, what could derail what we're doing right now is too much supply. So in Houston and Dallas, we're I think 99% leased and 98% leased respectively. So our portfolios are doing well, but in certain submarkets, supply is ahead of demand. Now, across the board, by the way, I think supply is as in check as it's ever been at this point in a cycle. I think there's some good reasons for that, and I think that's going to continue. But here's some good news. So in Houston, when oil prices are cut in half, the Houston economy is going to be under pressure. In the first quarter, I believe the torrid development pace in Houston went to 1 speculative start in the quarter. I may be wrong. Somebody from Houston tell me if I am. But, and I think in the second quarter there'll be more than 1. But that is stopping on a dime. So, you know, in prior cycles, we did not see development communities respond to a change in the macroeconomic environment that quickly. So I think that's good news. Turning to the east, maybe I'll start with Steve Martin's hometown of Atlanta. Atlanta's the last of the big industrial markets in the U.S. to recover. And during the last year, we've got a big portfolio in Atlanta, I think 18 million feet. Our occupancies are up 500 basis points in a single year, so high 80s to mid 90s. So that market has really turned around, and it's a little bit inexplicable, frankly, to me that it took so long, but we're pretty bullish on Atlanta long term. And then finally, I guess I'd talk a little bit about New Jersey. I'm sure we have a big New Jersey contingent here. New Jersey's probably got a little bit of excess construction right now, and we're the culprit on quite a bit of that, frankly. But the market's very well occupied, and I think long term, the Port of New Jersey has a really strong future, and we love that market long term. Right now, you know, probably supply and demand are in equilibrium.
That's great. We're going to move into another section called Search for Yield. Where are you guys making money? And a year ago, we had a similar panel at SIOR, and we talked about the difference between build-to-suit and spec on a risk-adjusted basis. You know, what developers preferred at that time. So I'd like to see if Carl still has the same opinion he did about doing build-to-suits a year ago as he does today.
Well, the spec market's improved dramatically, and the returns in the spec market have improved dramatically. In general, my feeling always is, I'll take a build-to-suit, period. I mean, I'm rarely so sure of myself on product that I'm going to say, I'd rather have an empty building in search of a tenant as opposed to having a tenant and a building. Now, your returns reflect that certainty and risk adjustment. And you know, perhaps if you have an inside building in LA County, or an inside building in Chicago, or an inside building, you know, in Silicon Valley, you probably, those are exceptions to that rule, because they're as good as leased once you get your permits. But in general, the speculative returns in this last year have been much higher than the build-to-suit returns, and will probably continue that way this year. And then we'll just have to look how the supply and demand works, you know, for next year and the year after. But at the moment, you know, all of my partners in these various areas, local partners in my organization, everyone has turned into a genius, except for my Texas partners with the drop of oil. They've got a little bit of a tough road to hoe to get through this period of time, but it's just that all of the speculative projects are all leasing up very, very well, but it's not over the top. It's just really steady well, I think, at least from our experience for our product. So the answer is now I would prefer spec product, infill product in LA County, you know, or Orange County, or Chicago, or New Jersey, or Seattle, Northern Kent Valley in Seattle. We've got a lot of success there. So that's what I'd prefer, a building there. But other than those particular cases, build-to-suits are always the best. And there's not as many build-to-suits percentage-wise as there were, because now there's more spec product available for companies to move into.
Jim, do you have the same view on this?
Yeah, it's slightly different. When we buy land, we're looking to build spec. We get it entitled, and we're ready to go with a spec building. And I would say 5 out of the last 6 times we've done that, we wound up with a build-to-suit. And so you have a choice then. You can build the spec, or you can demand a higher price on the build-to-suit. So I frankly, you know, prefer build-to-suits, but we always start out underwriting it as a spec building.
Yeah.
So if it underwrites out at spec and you've got a build-to-suit client coming in, now there's some people like to negotiate real hard, and we like to negotiate real hard. So it's either, you know, we'll do the spec building. Well, wait a minute, you know, maybe we should revisit that. So some good negotiating going on, but I have to tell you, there's a lot of Fortune 500 companies out there looking for modern space in the industrial world. I mean, 32, 36-foot clear, and they're moving out of 18-foot clear buildings. I mean, let me tell you, you know, there are a lot of companies who need to step up and grow their top line. If you think about it, most of these Fortune 500 companies, their stock is in pretty good shape right now. How did they get there? They got there because they cut expenses out, and so they were profitable. Stockholders are getting a little restless right now. They want them to grow the top line because their profits are about as good as they're going to get with the revenues they got right now. So they are looking for modern products. So when I look at the build-to-suit thing, it's really been a result of owning land that we were entitling to build a spec building on. And it comes as close to a triple or a home run, Carl. Yeah. I mean, the Pirates are ahead of us right now. I don't know what the score is, but I know Carl's way ahead. But we're catching up. What's the score, Jim?
With you guys, I'm definitely not keeping score. You're all winners, put it that way. But
Oh, are you
think
running
they're
for
tied.
office?
No,
Are you
they're
running
tied.
for office right now? I mean, that was a politician's answer. If I
was
ever heard
thinking
one.
about it, but I wasn't going to make my announcement today. So, in terms of, you're in the same camp in terms of the risk reward between build-to-suit and spec?
From my perspective?
Yeah.
Well, I mean, maybe just to be a little controversial, I believe, I'm kind of on the same page, but, you know, build-to-suits are not a no-risk proposition, especially right now. So if cap rate's backed up 25 basis points while you're getting the deal done, you're in trouble. So what we find is that, or what we're seeing, is that in some secondary and tertiary markets, the build-to-suits are getting priced to a margin that I don't want to play, because it's a toss-up whether you're going to make any money on the transaction. So I think Jim and Carl have talked about, well, assuming the underwriting pans out, here's what I prefer.
Yeah, yeah.
But let's not kid ourselves. You know, but you gotta deliver the building. You gotta deliver it on time, and you gotta hope that the capital markets environment is what you expected. So, I'd just throw that out there.
Good, excellent. So we're going to go ask Jeff about cap rates. And just a simple question, is there more cap rate compression ahead?
Well, like I said earlier, we have not seen a trend where that compression has stopped. So the momentum leads me to believe that it is going to continue to go down because there is more and more capital out there today that is looking to place that money. And the other thing that we're seeing out there is that your price per square foot is really now getting high, way past replacement costs. So now we're getting into that red zone, that danger zone for a lot of people, where you have to really step back and understand that industrial real estate is a very simple business, and you should be focused on the basis that you're going to own that asset at long-term in that market. And once you stop forgetting those fundamentals, I think that there should be concern. So two things, cap rate compression are working its magic, and also rental rates are increasing. Therefore, your price per square foot is going up, and people are really, really pushing the pedal right now.
Well, in the price, Jeff, is what happens is land owners start seeing that, and they quickly decide, we're going to take all of that increase. So
Yeah.
that we can, so that then your replacement
On the
cost
land value.
is the same. That's right. So land costs have just started to reflect going crazy in terms of that valuation, and that is not sustainable, over time.
Well, you know, you talked about that in Las Vegas, and the problem is if you've got 200 acres, somebody's trying to sell you 200 acres, given the land price that these guys are looking for, I mean, the difference between wholesale and retail is lost on the land seller.
Yeah.
Okay? So what happens is you've got to build on it right away,
Yeah.
especially if you're going to sell it into a REIT market, or if you're going to sell it into a pension fund. They want returns right now. Nobody wants to sit on an extra 100 acres. So the problem we all have now is we're taking land down in parcels. You make 200 acres, all right, we'll buy the first 50, and we'll see. Then you get into the point where you got to put a road through there, you got sewer and water, you're spending $1.25 a square foot for the rest of the land. You almost have to go with the second half. So it's a real difficult thing with these big parcels of land right now for all of us in the development business. It really has become much more problematical, I think, than even pegging cap rates. At least with industrial, these industrial deals take about a year to put through. I mean, unless you're in California, which it takes a year to get entitlements, and then argue with the CEQA people, so it's a 3-year process here, I guess. In Chicago, it's just a matter of hours.
If you know the right people.
Well, you have to know the right
For the
people,
right-
Jeff. I mean, gosh.
For the right
Hey, Carl
personal-
knows all the right people.
Yeah.
He's a newbie for Chicago. Gosh.
Yeah.
Cap rates, just one more point on the cap rates. I understand that, cap rates are still going down perhaps, but on a historical basis, with the spread of cap rates, that might not be the case. And if you would sort of explain the historical spread where we are in this cycle. And one more thing before, something's really ringing here with the clock, and I don't know if we need that, but it's like buzzing and buzzing and buzzing, and it's disrupting people sitting down here. But
It's the
Anyway,
new- it's the
back
new-
to
it's the new
historical
iPhone
Jim,
facts.
do you
he's
want,
got in
do
the
you want me
box
to
over
fix
there.
the clock, or do you want me to talk about the spreads?
Well,
We can unplug it. But, so that's a great question, because 10-year treasuries are up 50 basis points in the last month, right? I don't know what they are. They're almost 2.5 this morning. So we have been going along with about a 350 basis point spread to cap rates. So today, that's probably more like 300 if you just look across the board. And that's still 100 basis points wide of a normalized spread if you go back over the last 20 years. So there's some room to grow. I think interest rates, and if let's use the 10-year treasury as the metric, can expand over 100 basis points. And I don't think you're going to see much of a change in the cap rate environment because confidence in rent growth is probably growing, and probably more important than that, you get this wall of capital. There's more supply of capital than demand out there. And there's one other thing I would point out. All of us on this panel are old enough to remember this. Spreads to U.S. Treasuries through most of the 1980s were negative. So people did deals all the time. When I first got in the business, there was no such thing as positive leverage. Everybody did negative leverage deals. You say, well, why would you do that? So the younger people in the audience, well, that doesn't make any sense. Well, it's because you didn't have enough equity capital, and you were confident that your income stream would grow. So that was a condition that existed. I'm not suggesting it's going to happen again, but it happened in the past, and it all depends on how aggressive capital gets. So you might see the spread to risk-free investing get even tighter than that, 200 basis point spread. That's why I think I'm somewhat comfortable. I think cap rates are probably going to expand a little bit over the next couple of years, but I'm pretty comfortable it's not going to get out of hand.
Yeah, Gene, I agree with that wholeheartedly. When I started in this business, it was probably closer to 200 basis point spread for the risk of being in real estate over the 10-year treasury. I know a lot of people talk about 300 basis points, but when I got in the 60s, if you were 200 basis points over, you're feeling pretty cocky. And if you're really out on the risk curve, you might have gone to 150. Well, now we're 350? I mean, there's a big spread right now. The other thing is remember what's going on, all that European money that's coming in right now. I mean, if you look at Germany, and they were negative on their treasuries there for a while, we are seeing a tremendous amount of capital. You talk about a wall of capital. There's a wall of capital coming in from Europe. There's a wall of capital coming in from Eastern Europe, where there's a lot of unrest. We're seeing it come in from all over the places in the United States as a safe haven. The bigger issue I've got is, frankly, with apartments. We do a lot of apartments. It takes 3.5 years to get an apartment done, up, and really ready to sell. Being a merchant builder, if you think on the industrial side, you got to peg cap rates. Try figuring out what the cap rates are going to be in 3.5 years. The good news is, at least if you hold an apartment, the rent growth is going to be there, but you may have to hold it for 3, 4, 5 years. So when we look at our apartments, we just kind of wring our hands and say, we call every economist we got, and they don't know. I mean, how long have they been predicting that cap rates are going up, interest is going up? Last I heard it was September, and now we're talking January. We'll see.
Well, you brought up something interesting, and while you have the mic, what is institutional capital looking for today versus what they were looking for maybe a year or two ago?
I think they've lowered their standards, very candidly. I mean, we're doing a sub 4.5 cap rate up in the Bay Area. And a year ago, they would have been talking 5.25. So it's the rates have compressed. I mean, there's no question about it. How much lower in 4.5 are they going to go? I personally, we're underwriting at probably 25 basis points on a spread. We're going to do basically a really analysis on what happens to our deal if we lose. Rates go up 25 basis points. What do they go up 50 basis points? We don't anticipate, certainly in the industrial world, anything over 50 basis points right now. Probably 25 would be the most we could see, and we don't even expect that. But when we're doing apartments, I have to tell you, we look as much as 75 basis points, because it's 3.5 years from now. War breaks out, what the hell, airplanes crash. You just don't know what's going to happen. and there's nobody out there that's predicting, these unusual circumstances. So the risk for longer-term projects, I think, is much higher on the cap rate side.
Well, I'm going to ask my question to Carl now, and the question is, with capital today, is that driving you to do different projects now than you would have done a year or two ago in terms of perhaps location and the size of the building?
Well, yeah, the answer is yes. Because 2 years ago, capital was still nervous about moving in, and moving in on speculative projects especially. And it's been in the last 24 months that capital has felt comfortable with speculative projects. I'm not as sanguine as the rest of the panel is on cap rates. I mean, our feeling is, as developers, and it's one thing if you have a fund and you have to have a certain return, you have to have the assets out, and you have to have some sort of income. You got to find the income and alternative income. You have the money chasing you, like the big ball of stone in that chased Indiana Jones, in his first movie. You have that money chasing you. You got to do something with it. That's one thing, because you have to get the money out, and you're always looking for relatively today's analysis on where you can put that money out, because you got to get a return on it. So another thing for us, especially in our world of merchant building to a large extent, we are basically underwriting our projects assuming 75 to 100 basis points higher exit than the lowest that we've heard. We think there is a chance that you could see a 100 basis point pop in exit caps. You're not going to see it in 4 months or 6 months, but if it takes you 2 years to get a project up and leased, you can't afford to assume these very low. Now the problem is that the land sellers are assuming that you're going to have the low exit caps, because they just write it back down to what the cost of the building is, and they're assuming that you can afford to pay these really high land prices, which you can't afford to pay. But then your competitors are rich ones like Jim, pay those high prices. No, but we all battle the same problem, and so it becomes, because then you say, well, I can't play at all, and then you go to yourself as a merchant builder, and you say, hey, look, there's big companies out there, the Prudentials of the world, and the CalPERS, CalSTRS, Ohio, all the big players. They have to get their money out. They're in a different financial position. So you can provide or you guys in a lot of position, you guys, we can provide the product for you, and for those people, and say, listen, you can take that risk. We can't afford to take it. You have to take it, because you've got that, that big ball chasing you. But we can't do it. But I do think, if I predict no, they're not going to go up. They're going to stay about where they are. But there is a significant chance that they're going to go up 100 basis points. If they go up 100 basis points, a lot of these projects are underwater. And so from our standpoint, we kind of build that into our analysis, and then we look at it and say, well, do we really want the job, do the deal? And then it's a different analysis. It depends how hot you are to get a particular project done. And then you play with your own analysis.
Okay, here's what we're going to do now. I think we're going to move into our halftime, but I want to ask Jeff the same question from a public company about, is he building things differently today than he was 2 years ago? And during our halftime, we just have a 5-minute halftime. We're going to take a couple of phone calls from the floor. So if anybody has any questions, find the mic, and we'll take a couple of phone calls. But Jeff, if you can just answer that from a public perspective, what are you doing differently today than you were 2 years ago?
I think well, again, public companies have the same issues as everybody here at the table, trying to find a way to build and buy or do value add across the market. So what we're doing today is we're finding ourselves doing more new construction, and then after that I would say value add development, and then lastly we're not being able to compete on the acquisition side. So we're continuing to look at and evaluate it, but our trends for our company today is more in the development side. And so what that means for us, or for any institution or REIT out there, I think what they're doing is they're reevaluating where their core markets are, and they're expanding those areas and pushing those boundaries out so that they can put product on the ground. Whereas maybe 2 years ago or 3 years ago, we might have said, no, I think that's a little bit too pioneering. Today, we're having to reevaluate those locations, and we're having to kind of move that boundary line down a little bit so we can continue to put the product up and to provide net operating income for our shareholders.
Any questions, callers from the floor at this point? If you have any, raise your hand. If not, we'll just cancel the halftime and move on. Okay. We're going to move into another section called Balance in the Markets. And NAIOP publishes a quarterly demand forecast. And their most recent forecast says right now we are witnessing a lot of pent-up demand being fulfilled from the end of the recession. And once we go through this accommodation of pent-up demand, then we're going to moderate demand more to GDP levels. And to give you some numbers, net absorption first quarter 2015 was around 65 million square feet. And by the time we get to the end of 2016, they forecast absorption moderating to 48 million square feet. So it appears that will be less tenants in the market. So Gene, I know you do some research, and I'd like to see if you agree with that forecast.
Well, the NAIOP forecast is on a different base than we look at. So the numbers that I'm going to give you are a different base, okay? So we think that this year you're going to have excess demand. There'll be maybe 150 to 170 million square feet of deliveries and about 225 of demand. So excess demand through 2015. That'll continue through 2016, but at the end of the day, we think 2016 will be in totality equilibrium, about 225. So we see demand flattening out at 225 million square feet and supply at 225. So I don't think we're far off. But I would say a couple other things on this. I think population growth, frankly, drives industrial or logistics demand more than GDP. So I think you got to be a little bit careful about how, how your forecast is done. And if you look at those numbers in comparison to historical numbers, in the 1980s, every single year except one, there was more than 200 million square feet of industrial space built in the United States. Every year except one. Now, vacancy rates went up throughout the 80s too, by the way. In the 90s, first part of that decade was really bad for real estate, and all of us know about that. But the second half of the 90s, you had about 250 million feet of supply and 250 million square feet of demand. So what's important here is that in the 80s, what I'm talking about was 3% of the stock was built every single year. In the late 90s, it was about 2.5% of the stock. Today, we're building about 1.25% of the stock. It is tiny. And the deliveries as a percentage of stock and demand is really what's relevant, not the broad numbers. So that's why I feel like the supply situation is actually even better than some people portray it to be, because in the historical context, it's really low.
But rents are reflecting that right now, because you're seeing rent pressure, other than maybe Houston, you're seeing rent pressure in all the markets, and I think it will continue. You will continue to see that through this period of time. Also, there's a different,
Yeah, go ahead.
the difference in terms of the types of building we're building, the shifting from traditional logistics to the modern internet logistics. And that's changing the game.
And who's building it?
Yes, right.
Yeah.
Yeah.
And I think the other thing that I'd like to add to it is that the rents are climbing and people are very satisfied with the rent growth that they're getting. But I think more importantly, the concessions that developers are having to give up today are much less on top of that. And number two, you really have to pay attention to what the rental bumps are. Rental rate bumps per year have increased across the U.S., and the tenants are allowing that to happen. And I think that's going to be a big mover all across the U.S. I could name that as example in every market across the U.S. So I think that's something also that's really important to realize and recognize on top of rental rates just increasing.
You know, I'm a little more optimistic than the NAIOP report. We're seeing a lot of functionally obsolete buildings being torn down, certainly in Chicago. I mean, some of these buildings were built in the 40s. These buildings are being torn down. So when you talk about square footage, I mean, we're tearing, buildings down and building new buildings. So, when I look at the numbers as far as new product goes, I feel a little more optimistic than the NAIOP report.
Good. I hate to ask my teammates here, but since the clock was turned off, I don't know what time we have. How much time do we have left?
We're half an hour overdue.
Yeah.
Feels like that, doesn't it? It certainly feels that way. What's
Who's going to go get the beers?
It's
quarter of? Good. So, very good. All right, I'm going to talk about deals.
Jeff
Maybe
has
that'll
new
be
iWatch. What does the new iWatch say, Jeff?
We have
It's at
15 minutes.
6:30.
Oh, there you go. I see.
All right, let's talk about deals for the next few minutes, because that's what we're all here for. And so from the public and private viewpoint, if there was a 7 or 10 acre site in infill LA or a 25 acre site in Inland Empire, I'm going to ask Carl, what would you build on that site versus maybe what Jeff would build on the site from a public and private perspective? So,
I don't think we'd build anything differently. I mean, than what the public would build. I mean, it depends where you are in the infill. You're not going to build if you're in tight and you're spending $30, $35 a square foot for your land. You're not going to build a 500,000 footer because that user is going to look to the Inland Empire, that size user, and look for cheaper rents in general. You're going to build the 100, 150, maybe 200, that captures a local company that needs to be in tight, needs to be enclosed.
but let me ask you about that, Carl, because you have another business also building for users. So if you took that, say, 7 acre site in central LA, would you build the same distribution building that your public counterparts would build, or would you try to get maybe more coverage on that building and build that building for sale?
Well, and this is the argument we have in our investment committee all the time. It has been, it's because of the increase in rents, it's not as true at this moment, but it has been that the projects underwrote much better as a sale in the sale market for the smaller buildings. And so you had a tendency to build for that. In our investment committee, we say, great, it underwrites as a sale. It better underwrite as a rental rate, as a rental also, and if it doesn't, we're not going to build it. We will not buy something and build it now. I did that last cycle, and with Jeff, as a matter of fact. And that worked great until the music stopped and there wasn't a chair on the horizon, And so what we do now is we underwrite for both. But the answer is yes, I will build for the user market. For the public market that are trying to build their own whole portfolios, they might not be as inclined to do that. In that sense, you're right. It might be a little bit different product from that standpoint. Mm-hmm. But when you say increased coverage, what you're doing is you're just building it to what the user demand in that area is. But we also look at the rental rate because sometimes the users don't come. And in fact, I just had that run in Seattle, where we have a bunch of small buildings that we have up in different locations, and the underwriting was rent versus build. Build was going to make the profits that we wanted, but rent was okay, and none of them are selling. They're all renting, and they're renting at higher prices, so the underwriting came in fine. So you have to appeal to both, unless it's a build-to-suit, and then you build whatever the customer wants.
Mm-hmm. And Jeff, what about building 40-foot high buildings in this market?
Well, I'm going to get back to answering the first question with Carl and the differences. And a couple of thoughts. In the Inland Empire, the rental rates are higher for a 500,000 square foot building, say 40 cents a square foot, versus a 200,000 square foot, or 200,000 square foot buildings. You're going to get 35, 36 cents. So economically, we're both going to build the larger building in the Inland Empire. And either we're going to lease it out, or Carl's going to have a partner who's going to lease it and make more money that way. And then when you talk about Southern LA, you have to step back and you have to say, well, if Carl and I are bidding on that deal, on the same piece of land, probably the only way that he can pay the higher price per square foot is to build a small building for sale product, and the only way that I can't do it is because I want to build it for rent. And so I can't compete with the guys that can build the smaller product and turn around and sell it to the user at a high price per square foot, because at the end of the day, in LA, you will get a higher price per square foot for that building than is if I built the 100,000 square foot building, leased it up, and then sold it. So in that case, Carl would win, and he would get the piece of dirt in LA, and I would be very competitive with him on the Inland Empire property. But that's the problem, is that you just can't compete. In Southern California and LA as a REIT, it's very difficult to be able to buy land and build it for lease and own it. It's literally almost, I'm not going to say impossible, but it's pretty darn close. Gene, I don't know if you agree with me or not.
No, I agree. In fact, another example would be, let's say it's a site in the South Bay.
Right.
Because everybody was at the port this morning. What we'd probably want to do, and Carl, tell me if you think I'm wrong. Let's say it's a good-sized site and you can build a, 300,000 to 400,000 foot building. We'd probably, if we're going to build a hold, would want some more trailer storage and truck storage on that site.
Right.
And you're going to build it and you're going to sell it. And let's assume it pencils just fine, and functionally it's okay, it just isn't kind of optimized. That's kind of where we would lean, and we're not winning that bid.
Yeah.
Although, with trailer storage rates keep going up, maybe we will. But I think that's maybe, do you agree with that, by the way?
Yes, I do agree with it. And
So,
and
Carl, you're going to buy that 6 to 7 acre site then? Because I'm not buying it.
right. Well,
Because it's too small. I mean, you're not, that's not institutional quality. I mean, if I had a 100,000 footer, would you buy that, Gene? I mean, most of the people we work with, they're 250 to 1 million square feet. I mean, I don't know, and if you want trailer storage, you're talking 80,000.
You call me and I'll buy the
Hey,
100.
Jim, stay out of
If
that.
you can make the numbers work.
All right, I'll do the deal. I'll talk to you.
If you can make the numbers work,
Shake
I'll buy
hands
the
on
100.
that.
You
That's
got
a
it
good
right
deal.
now.
All right,
I'm
we
on
got a
that
deal.
deal. Carl, you're out.
Carol, you were in, but now you're out.
You're in, now you're out.
It's that, you're right, it's a different marketplace, but it is a resilient marketplace in the small users. And there's not only the user sales that you're talking about, there's also all sorts of small investor sales that you're talking about. And it is hard. I mean, he's talking about balls chasing you. My overhead's a lot bigger than yours is. And so that ball chases you, and you have to make the deals where you can on the small assets. We like the small buildings in this. We do a lot of business in this small building marketplace, and it's a strong product for us. But it is not an institutional product. I mean, you're right. It's either an owner-user product or a small investor, small trade investor product. It's just a different marketplace.
All right, we're going to wind things down with, I want to get the answer to that 40-foot high ceiling. And do you think tenants really want 40-foot clearance heights?
Okay, well, first of all, there are tenants that do want the 40-foot clear height. In my past experience, the only time that's happened is in a build-to-suit situation where somebody comes to you and says, we really want the 40-foot clear, and we're going to mezzanine, and we're going to use all that area for storage and utilize the cube. I've gone from building buildings from 24-foot clear in my career, 30-foot clear, then they get talked into 32-foot clear, now they've talked me into 36-foot clear. And Gene is the king, because now he's building the first speculative 40-foot clear in Tracy, which is going to be fascinating for me to watch
That's
and
right.
see how that plays out.
He's braver than I am. I know
Very
that.
brave.
I'm very
And you should have named his team the Braves.
So let me give you some
Yeah.
feedback on that. So we have, so that project's well underway, and there are 3 users looking at it, in all honesty. One of them really wants 40 clear, and they're gonna lease our building, or they're gonna do a build-to-suit. And will we get the excess rent we need to pay for the incremental costs out of them? Who knows? The other 2 users are fine with 36-foot clear. I don't know if they're gonna find options, but to be really honest with everybody, we're building that because we're gonna own that building for a long time. And we're building that really for the future. And we have the luxury of doing that because we have a balance sheet, and that's in a park that has 1,000 acres, and it's a little bit of a unique circumstance.
And I think it's close to the Bay Area, which is going to lead to people that can utilize that type of storage too in that
There was also
market.
an underlying demand there before they started the building. Those
Correct.
users were
Right.
floating around.
Right.
And
And he built product in the market with
Right.
that clear height
That's true.
for users.
And we have a 40-foot clear building built for
Correct.
Amazon out there.
Right.
So,
You know, we were in Chicago, we had a roundtable like this, and most people are now building to 36. And we asked IDI and the various people, okay, how many of your clients are using 36-foot clear? It ran between 13 and 15%. So when we sell these buildings, you know, the market wants a 36-foot clear building. The users don't seem to be using 36-foot. So if there's really kind of a breakdown between the folks that want to prepare for the future and hold these buildings and the people who are using them today. So we're always torn between, you know, we got to sell this
But
building.
you're picking up on the sales. I mean, it's only $1 a foot. 36 to 40 is more.
it's more, yeah.
But it's only $1 a foot, 32 to 36.
Yeah, but you know, we don't have as much money, Carl.
Oh.
We're a buck is a lot of
Yeah,
money.
buck is a lot of money.
I mean, you got a lot of money.
Yeah, I think fundamentally the problem is here for Gene and I, we're long-term owners, so we're going to build the higher buildings because it's what we don't know in the future, and what the future brings is why we do it. And but I will tell you that there are a lot of brokers here in this room, and when you have a client that wants a 32-foot clear building and they're okay with that, and they really don't ever want to go to 36-foot clear, at some point, somebody's going to figure out in this room that the inefficiencies of being in a 36-foot clear building with the column spacing going from 52 to 58 is a tremendous hit on your rent because they can't use the space. And it's because your columns can't move, and so therefore, and the pallet sizes don't change. So therefore, your aisles are going to be larger, and therefore, there's probably anywhere from 10 to 15% inefficiency in that building. And I think at some point, the brokerage community is going to figure that out and actually use the 36-foot clear building as a disadvantage because of the inefficiencies and versus the 32-foot clear. So be careful when you're looking at that. Now, however, I'll say that,
right.
but then everybody out there who's a broker says, my client wants 36-foot clear. Why? Why do they want it? They don't know. Okay? So, you know, you just kind of go with the flow and do the best you can.
I think you're right. That's a risk, and that's just reality.
Yeah.
But users figure it out. You know, in New Jersey, they've been building 36-foot clear for a long time, and they have column spacing all over the map. It's like 48 in one building and 56 in another building. They figure it out. In Brazil, we have 6 million feet of space that's all 39-foot clear. It's 12 meters clear. I'm telling you, 3/4 of that space they use every cube. And the reason they do is it's the only modern space that's ever been built, so they buy all new stuff. And they buy new forklift equipment, and they're not trying to use the same equipment that was in the last building. So it's kind of ironic in a, emerging economy that the customers would actually use it more,
Right.
more than ours would. But I guess the point is that users figure it out somehow.
And also,
I don't know.
it would have happened before, but the ESFR didn't allow you to.
It won't allow you
And,
to store certain products in there. You can't put the tires, class 4
tires,
commodities
yeah,
in there.
Tires are a whole different.
And then the other thing is,
topic.
you go out and you buy all the racks and all the picking equipment for that 40-foot clear building, and all of a sudden you need to expand and grow, and you can't find that 40-foot clear building because somebody else hasn't built it. Now you've got all of those racks and the equipment to pick it, and now you've got to go out and buy new stuff if
Well,
you
then
want to
Jim will
move.
do a build-to-suit for him.
That's
Then
when
we
you call
might have to
Carl.
renew the
No, he'll
tenant.
move into Gene's building right away.
Yeah, I know.
Gene's
He'll
got
move
3
to
of them.
Tracy.
All right, I'm going to just ask one more time if we have any questions from the floor. We have 5 minutes, and I can't believe we don't have questions. for
Somebody's
this.
got to have a question out there.
If you would go to the mic, we have a mic set up. Barb, where are the mics? Where are the mics?
I think I found one. So,
All right. if
question,
you-
you gentlemen touched on it a little bit, but the smaller product, there's obviously a lot of members, the NALP members that are aggregating some of that smaller product and hoping to one day become the Prologises and DCTs of the world. How does that impact, do you see those folks as competition? Is that a new audience for you, maybe Jim or Carl, in terms of who you guys are going to sell to? Again, maybe it's too small for the DCTs and Prologises, but how does that smaller product and the players that are entering in that, and I think it's an emerging market as well in terms of institutional capital partnering up with some of these folks.
Well, I
Well,
think
I-
he's got it. What is smaller product? Define that first. Go back and tell us what you think that is. What size? What
Well,
size?
I
and
think,
where?
you talked about 100,000 square feet, 5-acre site, 6-acre site, is it too small for you guys to mess around with? So, again, in an O'Hare market in Chicago, it's, that's as big as you can build in some of these infill markets. So, again, however that might be defined in a particular submarket.
The ones that I see doing it are having a hard time with a new product. I mean, they tend to be aggregating B product. So I don't know if they can aggregate enough of that to become a REIT. I don't know. I don't think so. I mean, I think it's going to, the A product that's smaller, I mean, there's a lot of competition for that. The B product right now, you can do some aggregation, but there's just not a real strong demand. There was in 2005. There was a lot of people who couldn't, core product and everything, they were just getting beat up, so they went into the B product. And there were quite a few people who had gone around the country and had a lot of B product and even some C product. And the folks who bought that, didn't do well. I mean, when the recession hit, B and C product took a real beating. So I don't know. I mean, I don't know anybody that's buying new 60 to 100,000 square foot buildings that doesn't have a lot of competition. It tends to be private. I mean, it's not institutional stuff. It tends to be wealthy people who are just buying a building because they want to own real estate.
We had a question.
By the way, and it's also, it's tough to find, it's really hard to find a site where you can build a new building. So the amount of product that goes up really isn't that great. It
Right.
fits into what you're saying. And so the few that do come up, we get great prices on it from a lot of private buyers. You're right, it's a tough market to aggregate, but I think there is a play there. There is a play there for the right person. They just have to be really aggressive. And they're going to have somewhat patient money, because if you had, $300 million or $400 million of this stuff, all not modern product, it would be worth a lot, because it would be an all-day sucker in terms of tenants. So you'd always have it full. It'd always be but you would have to pay up and have a real belief in your business model. Because there is a lot of private competition to buy those buildings.
As long as you're in the
East
core
Group is
markets,
kind
I
of
think that's important too to
What?
mention. As long as you're in the core markets.
Yeah, you have
Yeah,
to.
yeah.
It's a core market. Yeah.
I think rents are growing faster now in smaller units.
Yeah.
I mean, it's amazing, and the occupancy rates have really, really ramped up in the last couple of years. So now you can pencil these deals, and so I think we'll see more of it. so
Well,
maybe that affects it.
14 months ago, 15 months ago, the small tenants hadn't shown up yet.
Yeah.
They've just shown up in the last year.
Right.
And they're starting to show up with a passion, I think because maybe the money's getting looser for them or whatever the story is. It does make you nervous. You know, we see all these big numbers like the gross absorption numbers and all that, you know, and everybody pats each other on the, these are all my genius partners, you know, they're all making money right now. But it's kind of like we didn't know why it didn't show up before, and it may mean we're not going to know why it disappeared again. And so I'm not 100%, I like the numbers, I can see out 12 months. I think I can see out 24 months, but I'm not 100% certain that I can.
Well, with that, I think we're out of clock. So I thank everybody for attending. Please join us now for a networking break in the Centennial Ballroom foyer. Our next session, Connecting the Links, Supply Chain Strategies for Success, will take place in this room at 2:30. And thank you for the All-Stars.
Hey, Jim, nice to see you.